there are other pieces of legislation that relate to contracts for the sale of goods. And over the course of time, in fact, the number of these pieces of legislation has grown as incidents have occurred that, call for the importance of this sort of thing. So the latest examples of this would be sales that deal with electronically facilitated deals, so buying stuff online, effectively. Okay, so the first major piece of legislation is something called the Trade Practices Act. And the Trade Practices Act is more or less geared for business-to-business deals more than anything else. So it prohibits misleading and deceptive practices, controls unconscionable transactions, such as, I'm going to charge you 150% interest. That would be an unconscionable transaction. False and misleading statements, conditions of a contract. If I make outrageous, these blueberries will cause you to lose weight like nothing else, right? So that would be something that would be probably a misleading statement. And so the Trade Practices Act is really geared for, as I say, it's more designed for a business perspective. That is, a business is selling stuff to people. And it comes up with some basic you can't do's. That's what it is. You can't do misleading, unconscionable transactions and false and misleading. So it really deals a lot with advertising in that respect. And there's a bunch of remedies that are in place in the contract. But the fact of the matter is that there is a piece of legislation here to help protect people in the event that they buy something or they get caught in a contract for something that is not acceptable. Consumer protection legislation also covers things like door-to-door salespeople. That's another area of business that has come up as problematic in the last few years because, the last 50 years, as the vendors go door-to-door, putting pressure on people to buy things. And the question is, is that fair? If you got an old lady and you're selling vacuum cleaners and you refuse, basically, you're the salesperson, and you go in and you say to yourself, I'm not leaving this house until I sell that vacuum, come heck or high water. Certain people, it preys on certain people and takes advantage of people. So you got people who can't afford anything buying a $1,000 vacuum, these sorts of things. So one of the provisions of the consumer protection legislation that is geared there, and again focused on business more than anything, is that if you got caught, if you were to sell something to someone or someone would buy something from you that they felt pressured or, in order to get you out of the house, they basically said, yeah, I'll have it. What happens is that this piece of legislation steps in and says, hey, you can't force someone to buy something like that. So what we have is what's called a cooling off period. And the cooling period says that for a period, I think it's 2 weeks, but it depends on the jurisdiction. If you were to buy that vacuum because you felt pressured, you had 2 weeks to kind of undo the contract, call them up and say, no, I don't want to do that. So effectively, it allows the buyer to reverse the contract after they kind of got their wits about them and said, no, I don't want to do that. Okay. There's another type of contract called executory contracts, and these are ones that specify a performance of something. That you had to execute something, to drill a hole, to dig it, whatever. So contracts which are underperformed obligations, okay, you didn't do exactly what you said you're going to do. You said you're going to build a house and you didn't build the garage, and we discussed whether or not the garage was part of it, that sort of thing. So if there's remaining obligations on both sides, what it does is it allows or facilitates or forces the sides to complete the contract. Okay, and effectively, in order to make that work, it has to be in writing, and then the courts will step in and say, okay, we interpret the agreement that you're going to build the garage, build the garage. We also got this issue of referral selling. A business that works on referral is that I buy something from you and I tell my friends, and they're going to buy something from you, and they tell their friends, and they're going to. So what we're doing is working on word of mouth to continue. So the trick is, there are legislative rules that say what you can give me for promoting your business. So let's assume that if you are going to pay me $100 to see if I can get a friend of mine to buy from you as well. So it deals with giving discounts if purchaser provides names of potential buyers to seller. So if I provide a list of names, that information has some, I'm going to call it privacy issues related to it. And there is legislation that deals with what they can't do with that information. Another interesting one, something called delivery of unsolicited goods. So this is where someone knocks on my door, puts in a parcel, and says, here you go. And I take it. Now, the question is, did I order it? No, I didn't. So what this does is prevents companies from sending people stuff and causing obligations, even though they didn't order anything. The companies say, oh, you're forced to pay for it now because you got it. So this puts restrictions on what companies can do with regards to unsolicited goods. This unsolicited goods, by the way, a more modern version of that came up a couple of years ago with regards to the cable TV companies. The cable TV companies basically put packages together, and they did what's called inclusion clauses. And the basic theory was that you bought it unless you told them you didn't want it. And so you bought these extra channels, and you're going to pay for these extra channels unless you tell the companies that you did not want it. And anyway, that went to court and was said they can't do that. Control of specific goods. Well, one of the big issues too that has come up in recent years is borrowing costs. Okay, if you go buy something, let's say from one of these finance companies like Easy Home, they will put the price of a product on there at $20 a week. That's generally how they price their items, as opposed to this couch is $1,539. No. They put the price at $20 a week for 50 weeks or 60 weeks or 150 weeks or whatever it is. So the question is that can lead to what's called deceptive information, because all people see is $20. They don't see what the true cost of the product is. So if you go and buy anything now that relies on an installment payment plan, such as Easy Home, $20 a week, the contract of sale has to have a clear indication there on what the cost of the product is, what the total payment that you will pay for that product is, and the amount that you're paying in interest, and it has to tell you what the effective interest rate is on that product. So effectively, the true cost of borrowing has to be displayed in the contract. Again, as I said, it's geared up for companies more than anything. The company is obliged to. So Easy Home is obliged to tell you what the effective rate of interest is on that purchase, and you will probably find it to be quite high. So these things have really come up in the last few years with the growth of these types of businesses and people not realizing how much the borrowing cost actually was. Another thing that comes up is that has come up in the last few years is payday loans. And payday loans are really a loan that you get from a store. So you go borrow an amount of money. Usually is not a huge amount of money. It's probably $1,000 or $2,000. And you pay it back when you get paid. So effectively, it's a very short-term loan. Okay. The question is what is the effective cost of borrowing for that loan? And just like the actual cost when you go buy a couch or something, the actual cost of the payday loan must be disclosed, and you will find that the effective interest rate is very, very high. Same idea with income tax returns. If they calculate that you get a a tax return or a tax refund from the federal government, they'll pay you right now. So instead of waiting for the federal government to get on the ball to send you your money, they'll pay you right now, and they basically discount the amount you get. So you're paying a fee effectively to get that money right now. And the question is, how much are you paying, and what is the total cost of that effective loan? Because effectively it is a loan until you actually get paid from the federal government. Credit reporting and debt collection are all regulated as well. We live in a world where people have a lot of debt, and there's a lot of information flowing around with regards to people's debt levels. So credit reporting Consumer Affairs, you will see that the list of items that are covered, and this is all form of consumer protection, is getting more and more, or is getting fuller of internet type based protections. Okay, so internet hoaxes, change letters, identity theft, product safety, distance internet hoaxes, Canadian consumer ham. All of these are, we're seeing a lot more of this with regards to the internet. And you can see here are all the little bits and pieces of items that are covered under consumer protection legislation by the Department of Consumer Affairs. Okay, so just want, and you see that each of the provinces have their own as well, and one will link you to the other. One of the things that we also see is that the provincial government has the ability to investigate. So if you launch a complaint, and it all works, the sad thing about this is a lot of this consumer protection legislation runs on the basis of complaint-based, is a complaint-based system. So no one's going to get charged with anything unless someone launches a complaint. So that's requires consumers to be vigilant and to alert government of these problems as they occur. Government has some powers to take action against companies if they are accused of ripping people off, I'll call it. So they, for example, can assist consumers to obtain remedies, so they can work with consumers. They can impose fines or revoke licenses. So, for example, sellers' licenses can be revoked. They can take civil action for damages. Okay, so you can sue the company effectively. And they can also point the consumer to potential criminal. So very rare that would ever happen, but it does certainly have provisions for the provincial governments to help consumers find redress in the event that they're ripped off. As I say, ultimately the Charter of Rights and Freedoms, which guarantees individual rights, covers all of this in terms of making sure that people are all taken care of. Some provinces have very comprehensive consumer protection acts. So, for example, Ontario does. Newfoundland does not have a great comprehensive act. But again, you got to think about the level of retail sales in Newfoundland versus Ontario. Okay, and you can see, for example, most businesses are in Ontario, so you would think that businesses there would be a greater degree of protection there. There's also a bunch of non-government agencies out there that help consumers, and again, it's focused on protecting consumers from business. The Better Business Bureau is an association that is put together by businesses. And effectively what it does is this organization, the Better Business Bureau, is designed to keep businesses from getting a black eye, giving a black eye to one another. So businesses are joint members of the Better Business Bureau. They can join the Better Business Bureau. And what they do is create an internal code of conduct. So businesses that are members of the Business Bureau, code of conduct on what actions they can and can't do. And the idea is that it's designed to support the member businesses. They'll wear that badge that I'm a member of the Better Business Bureau, and it gives consumers some confidence in the degree of what they're doing. So it weeds out unscrupulous business and provides service to the public who can inquire about specific businesses. So it is an opportunity for businesses to protect their name effectively. The Federal Competition Act deals with federal level businesses that are regulated by the federal government, again, based on the constitutional jurisdiction here. And a lot of the large corporations, for example, that would go across provincial boundaries are covered by this legislation, almost identical to the provincial legislation, but again, covering the companies that are registered federally under federal provisions. Now, the Competition Act, since it's come into place in Canada, has been given a large thumbs down by a lot of people, because it has yet really to do anything of any consequence to businesses that are found in violation. So the purpose of the Act, though, is to maintain and encourage competition in Canada. It is supported by the Competition Act, and it controls anti-competitive practices. It lays out, economic principles, these sorts of things that companies can and can't do. It prevents companies, in theory, the law prevents conspiracies to lessen trade. The idea of companies getting together to restrain trade. So fuel companies, for example, or internet provider companies, or cell phone companies, these are all federally regulated. And there's been lots and lots and lots and lots of complaints to the Competition Bureau with regards to this. Very little change, though, however. So, the rating on the Competition Bureau has been poor, because despite the number of complaints and what people would consider reasonably legitimate, such as the high price of phone bills in Canada, very little has been done. Federal Competition Act also limits or controls pyramid selling, these sorts of things that causes problems for a lot of people. It also forbids deceptive marketing practices. Full disclosure is required of merchants in many situations. Predatory pricing. Predatory pricing is just a fancy word. You probably run across it in marketing. It's a fancy word for a very large company with deep pockets cutting their prices to effectively put their competitors out of business. So, if you got two companies, one is a monster company and the other one is just a startup. Startup comes in with some low prices. The monster company lowers its prices with the intention of putting the other one out of business, and it probably will, because it has deeper pockets. It can afford to lose money longer. So that would be considered as predatory pricing, and there's all kinds of legislation with regards to preventing that sort of thing. It also manages mergers and acquisitions. Now, it has been all too common in Canada where companies have gotten together or merged into one. Just recently, for example, the oil industry. We've seen a lot of mergers in the oil industry in Canada, where Cenovus and Husky have gotten together, for example. When Air Canada bought Canadian Airlines. These are all considered as, companies getting bigger. But the fact of the matter is there's less competition as a result of it. So mergers and acquisitions they're all reviewed by the federal entity. Very few have ever been denied. In terms of, before I leave that, mergers and acquisitions are being reviewed. Right now, it's not so much in Canada, but it does apply to Canada as well. And I don't know if you've seen it in the news. The social media giants, Google and Facebook, are in a fight with governments in Europe and in Australia. And effectively, what Australia has been leading the band on this. So what Australia has done is they've said to the social media companies, listen, if you guys are going to be sending or repurposing or linking news from local companies, so for example, the Australian Broadcasting Company, like the CBC here in Canada, if you're going to put up a story on your feed that's from the Australian Broadcasting Company, you have to pay a fee to ABC for that. And the reason, the thought behind it is that, the companies are suffering because Facebook is sucking all of the ad revenue out of the system, and as a result, local news outlets are falling. And you can see that right across Canada, you can see it right across all the developed world, that Facebook is sucking the air out of the system and reducing competition. So the Australian government came up with a neat little plan to charge, and just yesterday in Australia, Facebook and Google are now blocking news from their websites in those countries. And this is going to lead to a very sea change in how this happens. It's either going to be a win for Facebook or a loss for Facebook. It's playing out right now, but effectively it has to do with the size of Facebook and the control that one company has over things like news, what's in the public interest. And the Trump experience has proven that we have to question these companies. Are they too big? So in terms of mergers and acquisitions, the legislation in Canada and most of the other developed world is going to be tested in the next few months, I would say, with regards to how big is too big and what is in the public interest and what can countries do in order to manage this. So keep an eye out for that. Another thing that we need to look at is this issue of secured transactions. Now, this is not so much to do with government legislation, but it certainly affects a lot of the sales or the contracts that are out there. And effectively, what that does, what a secured transaction is, it is I sell something to you. So I'm going to sell you my car for $50,000. Okay, I don't have a car that's worth $50,000, but let's assume that I do. So you say, I don't have $50,000, but I want to buy that car. So you get someone to what's called guarantee the loan. So effectively, you get a loan for $50,000 to buy the car. You give me the $50,000, or you're going to pay me over the course of time $50,000. Let's say it that way. Effectively, then, as long as you pay the $50,000 back to me, who really cares? It's just between you and me. The thing is, though, that if you don't have $50,000, or if you're untrustworthy, or these sorts of things, I may want what's called a guarantee, or to secure the transaction so I don't have any risk. And how do we do that? Well, we do that when a third party comes in. So effectively, you as the borrower go and get someone to sign a contract with you or a deal with you to guarantee that $50,000 loan. So in the event that you don't pay it, they will. So effectively, the third party guarantees the payment. This is what we mean by a secured transaction. So ensuring a debt will be repaid by providing security of equal or greater value and giving creditor first claim. Okay, so in the event of a secured transaction, instead of just two parties involved in it, then there comes a third party. So we got this third party is the guarantor. So what does the guarantor need, or what is it that is going on here, and how does that affect the system? So the guarantee is usually given to, an assurance of guarantee is usually given in the form of some other asset. So let's say, for example, that you own a house, and you own that house, and you say, well, I'm going to borrow the $50,000, and I need to get someone to guarantee it for me. So the bank says, okay, we'll guarantee it, but in order to guarantee it, we want to put your house up as collateral. So effectively, if you don't pay it, the bank will come and take your house to get their $50,000 back that they had to pay me. So, this is where it gets a little bit tangly, but effectively, some other asset that you own is tagged as the guarantee for the loan. That's effectively it. And if you don't pay the loan, that asset can be taken and sold and effectively used to pay off the loan. Now, these things are known as personal property, and they could be tangible, like a house or something like that. It could be intangibles too, such as shares, checks, any number of things that have some value. This little diagram here just more or less shows the way that it works. And we've got the debtor and the creditor. So someone's loaned someone something in the form of you owe me $50,000 for this vehicle, so you owe me a debt of $50,000, and it's secured somehow or another. Third party secures it. Your property or your house or whatever is secured against it. So the Personal Property Security Act deals with this idea of security. So the Act controls all secured transactions involving personal property, allows any form of personal property used as security, must have contract created securing the transaction, and title stays with the borrower, but the rights given to the creditor in the event you don't pay. So the steps to secure a transaction are pretty straightforward. First, we have an agreement, no different than what we normally have. Contract sets out the rights and obligations of the parties, specifies assets to be used as security, and the creditor has no claim at this point. So no different than any other transaction, really. We do the deal for the $50,000 for the car. Here's the car. There you go. But there's something attached. So the value under contract given to the debtor securities claims against the asset. So, for example, your house is the security. And the third item is something called perfection. Now, perfection is accomplished through what's called a registration process. So you have to register the loan or the security with the provincial government. So effectively, that $50,000, that debt, that idea of the house being security has to be registered with the province, and that's what's called perfection. So what it does is it gives the creditor, in this case me, priority. If you went bankrupt or something happened, you couldn't pay it, I get first dibs on that house to sell that house to pay off my loan. So all we're doing here in this is ensuring that the person who is owed the money will get paid by making that person the primary creditor on some piece, the primary lien holder on some piece of property. So we can that's what's called attaching, really, in order to make it to make the property, you attach the property, the house, and perfection is the registration process. In the event of default, the creditor has the right to obtain and resell the property used as security. So you don't pay the loan, I get your house, I take the house, I sell it, I get the $50,000. But let's assume the house brought in $250,000. Well, the 200 would, I get my $50,000, but the 200 would go back to you. I don't make money on this deal. I just get my money. So it usually happens through a creditor, his or her employees, or a private bailiff. So we get someone involved in order to get this money. So the creditor himself, the employee, or some sort of a private person who goes out and seeks that. So you've seen the repo guys on TV. Those are the private bailiffs. Can't use force or violence. And there's no need for a court order if contract gives the right to repossess, unless the property is not accessible. So you don't pay your loan on it, there is a right to repossess. So some items, for example, cars. When we go buy a car from a car company, you're asking, well, what do I put up as guarantee? Well, the car itself, usually the asset itself, is the guarantee for the loan. So that new Honda I bought, if I stop making payments on it, Honda will come and take it. So effectively, that is the guarantee for the loan. So the legislation gives us the right, if we are the ones owed money and we go and we got to try to recover the debt because someone didn't pay it, we do have the right to sell those goods. Goods may be resold to recover the debt. Anyone with interest, including debtor, may be notified and given an opportunity to redeem goods by paying out the debt. So I have to tell you, I'm going to put your house up for sale. Here's an opportunity for you to pay off the debt. Now, if you don't do that, I'm going to sell the house. If sold, seller must attempt to obtain a fair market price. This is interesting. I had a chat with the banks on this. A lot of houses, for example, have been repossessed in this town over the last little while because of the economy and the like. So the bank effectively repossesses the house. The house itself becomes the item. What the bank has to do, they're forced to attempt to obtain fair market price. And this is a big problem for a lot of real estate companies in Clarenville right now, is the banks own a lot of houses, but the banks are kind of cut. They can't sell the house for less than the fair market price because it would flood the market with houses and drop prices. So the banks, according to legislation, just got to obtain what's called a fair market price, and the companies ensure that they don't sell them too low. So the sale must be what's called commercially reasonable. Any excess minus cost of proceeds must be paid back to the debtor. So if I sell your house for $250,000, I take the 50, you get the 200. If a deficit results, so for example, you owe 50, only get 20, you still owe 30, the amount still owed by the debtor may or may not be recoverable depending on the province. So obviously a company runs some risks here. If I sell something to you for 50,000, you stop making payments on it. The asset that I have tagged as in order to secure the debt is only worth $10,000. I sell it for $10,000. You still owe me money. I might be out of luck. So again, it's important that we have some sort of a security that's worth more than the actual product. This gets into this issue of builder's liens, and this is for contractors in particular. Okay, so if you're a house constructor and you go do something to build a house or to build something for someone, you have what's called a builder's lien. So one of the things that the builder's lien does is it gives suppliers and subcontractors a claim against property if they're not paid. So it ensures that they get paid. You may register a lien against property, which can eventually force the sale of the property. So if the property owner retains a percentage of the money owned under the contract, a holdback, this is available to satisfy claims and remove liens. So what we got is a builder's lien can help guarantee suppliers that they'll get paid. Okay, so if you're building a house, the company that's supplying the material can get a builder's lien. So effectively, it has rights to the building once it's built to recover its money. And most times when you have a construction project, we have what's called a holdback. So someone builds a house for you is worth $100,000, contract's worth $100,000. There's usually what's called a 10% holdback, which is at the end of the project, you've paid $90,000 for it. And at the end of the project, this holdback is assessed to see if there's any liens outstanding. So it's held for a little while. If there's no liens, if there's any debts that are not repaid, basically, we clarify that those debts are not repaid, and then that 10% finally gets sent off to the contractor. And we also have this issue of guarantees, which we've already talked about. So if you guaranteed a loan for someone, so your kid goes and buys a car and you guaranteed a loan for the car, meaning that if the kid don't pay the loan, you do. So one person guarantor agrees to pay the debt of a creditor if the debtor doesn't. So must be in writing to be enforceable. So the banks will ensure that your name is going to be on that loan as well, right? And any defense that the debtor has against the creditor is available to the guarantor. So, we run into that. They can effectively send you the bill for the car if that doesn't get paid. If the guarantor pays, he or she assumes all the rights of the creditor to collect the debt. So effectively, he who pays is the one who gets the benefit. We got this final issue here of bankruptcy, and bankruptcy is an interesting little process. So effectively, when we talk about contracts and we talk about obligations in one party to the other, sometimes we run into problems where someone literally runs out of money and they cannot possibly fulfill the obligations they have. So we have a couple of terms that are beat around that we should be familiar with. First of all, there's the word insolvent. Insolvent means that you just don't have enough money to pay the bills as they become due. So you got $5,000 worth of bills coming due and you have $1,000 worth of income. That's insolvent because your cash flow is such that it is in the negative. Okay? Just because you're insolvent doesn't mean you're bankrupt. So insolvent normally would lead to bankruptcy, but effectively, a lot of people find themselves insolvent. Bankruptcy occurs when the debtor's assets have to be transferred to a trustee for distribution to unpaid creditors. So effectively, what happens is once you find yourself insolvent, one of the options that you have is to effectively go to a bankruptcy trustee, which is a third party that handles bankruptcy, and say to the trustee, look, I cannot pay my bills. My debts are greater. I don't have the cash flow to pay these now. I want to file for bankruptcy. So what happens is that the assets that you own then gets transferred in trust. They manage it for you to the bankruptcy trustee. And thing is, bankruptcy is a federal right. If you look at the Constitution back in 1867 and the 1982 one, it says bankruptcy is federal jurisdiction. So it is governed by the Bankruptcy and Insolvency Act, which is a federal piece. And the whole purpose of the act is to preserve assets of debtor and benefit of the creditors. So make sure the creditors get paid. And it's also there to promote rehabilitation of the debtor and give them a fresh start. Okay. So there's two ways to become bankrupt. Effectively, you can voluntarily become bankrupt. That is when you realize that, oh, I haven't got enough money coming in to pay my bills. So you can actually go after the trustee and, as I say, and ask for help with regards to bankruptcy, and the trustee will advise you accordingly. Or you can be forced into bankruptcy by your creditors. You don't pay your bills, the creditors can go and request that you be made bankrupt. This requires a receiving order from the court to do, and you must owe at least $1,000 and commit an act of bankruptcy. Basically, you're insolvent or some sort of fraudulent activity. So the job of bankruptcy trustee, the person that, or the company that handles your bankruptcy, is to counsel you, to manage the assets that you have, make sure that, if you got a car and a house, to take care of that while the bankruptcy process is going on, to figure out which creditor gets top priority. So for example, someone with a lien or something like that would have top priority. So to kind of prioritize the debtors, and then to sell the assets to get fair market value for them, and to distribute proceeds to the creditors. So effectively, it figures out who we owe money to, order them in terms of who should get paid first, and then it sells the assets and effectively pays off the debtors. In terms of determining the order back here, in terms of determines priority among the creditors, how does it determine the priority? Well, there's two types of creditors. There's what's called secured creditors and unsecured creditors. So secured creditors are creditors that you owe money to who have effectively gotten liens on products that you own. Okay, so they get paid first. So a secured creditor gets paid first. They're first in line to get paid, and if there's a shortfall, they become unsecured creditors for the rest of it. So if you owe 200 and the most that we can squeeze out of the sale is 100,000, that means there's still 100,000 outstanding. They fall into a category of unsecured creditors like everyone else. There's also, in terms of semi-good creditors, is preferred creditors, and the Act sets out who gets paid in the case of preferred. And funeral expenses, cost of bankruptcy, taxes, EI, workers' compensation premiums, these sorts of things are, preferred. Unsecured creditors are ones that are at the bottom of the heap, receive an amount, whatever's left over, effectively they get, and it's usually a percentage of what's owed. So, and the thing is with it is that some of the assets are exempt from seizure of the debtors. So they can't really draw everything away. Stuff that's necessities, for example, they can't necessarily take. Okay, so when you run into bankruptcy, a lot of people end up going that route if they get insolvent. And effectively, the whole idea of it is to get a fresh start. Okay. Some people do things illegitimately. So, for example, there are offenses, failing to fully disclose your assets, transferring property to a spouse or friend in order to interfering with the discharge. All of those things are illegal. Not supposed to do that. In order to be discharged from your debts, once all that process is done and that the assets are sold and paid off your debts, in order to seek discharge, the court has to do that application for discharge automatically made after 9 months. If first bankruptcy, will be discharged unless the creditor objects to the bankruptcy offenses, and a conditional discharge must be given. So you got this period of time, and once discharged, you're free of any former indebtedness. Now, the federal government, in their wisdom, have said, not all things you're free of. Student loan. We had a lot of students declare bankruptcy. Student loans less than 7 years old, family maintenance obligations, child support, and court-imposed fines. You cannot get away from those. You have to pay those. There are a few alternatives to bankruptcy. We don't want everyone going bankrupt. So there is, so these companies that you see around Tim Hortons signs, the whole idea of them is bankruptcy is a last resort. You don't want to go into bankruptcy unless you absolutely have to. So there's a lot of these debt relief people and agencies that handle people before they go bankrupt and say, what can we do? So, for example, they're in the process of negotiating alternative arrangements, putting proposals in front of creditors. Okay, if personal debt over $75,000, individuals make what's called a Division 2 proposal. Companies and larger debtors owing over $75,000 make Division 1 proposals. Depends if you're a company or an individual. And so effectively what they try to do is negotiate with the people you owe money to see if we can kind of come up with some arrangement. So large corporations tend to suck up a lot of this type of stuff in terms of it because, again, they're corporations. We're dealing with big dollars. So effectively, bankruptcy is a tool that helps ensure that people get their money, the debtors, the people who are owed money get their money, and that debtors are reformed so that they can come back in and get back into society and do whatever it takes to make a living. So effectively, then, that is the coverage for this section 3.